Hey everyone, Rich Monroe with B&B Investing. Thanks so much for jumping on. As usual, we're with B&B Investing. We want to try to navigate the short-term rental model, whether you're buying properties, leasing properties, or managing. And I'm super excited and looking forward to digging in today with my friend Bram Gallagher from AirDNA. We're going to talk about where we've been with the market and occupancy and nightly rates and what the forecast looks like. So, Bram, thanks a lot for jumping on again. Give a brief introduction for the folks that don't know you.
Yeah, well, thanks, Rich. Yeah, I am Bram. I'm the Director of Economics and Forecasting at AirDNA. AirDNA is a firm that scrapes the web for all the Airbnb and VRBO listings. So we try to get all kinds of data on the features that listings have, the pricing that they've got, availability, and publish it for the U.S. markets and the world as well. So I've been trying to pay a lot of attention. Of course, it is January, so my focus this last little while has been on capping up the year, seeing that how that sort of year-end performance has looked, and then forecasting or starting to look ahead to the future as well. So the presentation that I've put together today, it draws in a lot of those nationwide themes, but I try to relate it to the Atlanta market in particular.
Very cool. No, I like that we do that. I mean, we do have most of our viewers are here in Atlanta or definitely in the Southeast, but I think it's only prudent to always kind of be aware of what's going on in other areas and in general, so you know what to compare yourself to. So definitely looking forward to it. Yeah.
I should point out too, I sit in Atlanta as well, so I'm a local. So I've had a lot of interest in this market for a long time. Used to work with hotels for years and years up at the CBRE office up in Atlanta, Buckhead, and now I work for AirDNA. So always trying to stay on the hospitality side, but short-term rentals is a lot of fun for sure.
Right. So what I know that we had the last update from you just before the fourth quarter, I believe, and so we've got the year-end closeout for 2024, and what's your general opinion about where we ended up with 2024? I know there's been a lot of hosts that have experiencing delays and reduced occupancy rates, lower ADRs, and things like that. How did you see the year finish as far as that goes?
Yeah, well, and I can get into it in sort of more specifics, during the presentation, but I would say 2024 was definitely a much stronger year than 23, which was a really difficult year performance-wise. A lot of people struggled through 23, but 24 was something of a reset. Supply and demand finally found their balance. Occupancies are starting to improve now rather than retreat as they have been for the last few years. So there's a lot of positives about that. We've got inflation under control, which as you know was a huge blow to a lot of the leisure travelers' budget. So I think that outlook is much improved. And also in this presentation too, I'll look ahead a little bit to see we've got a new president now that we've elected since the last time we met. There's some policies that he suggested. So me and my colleague Jamie Lane at AirDNA, he's the VP of research there. We both looked at some of the suggested policies, and we're trying to look to see how would that affect the short-term rental market. How is that going to affect operations, investment? That sort of angle.
Very cool, awesome. Well, I'm definitely anxious to dig in. So let's go ahead and see how we are looking with your presentation.
Sure, yeah. And I always bring up this chart, but it's just a nice chart to kind of tell some stories with. The overall story in the U.S. had been that we saw supply fall down during COVID, and then it had just rocketed up. And you can see in the first 3 years after COVID, 21, 22, 23, those available listings rapidly approaching that dotted green line right there. That's our pre-COVID trend. But this year, we started to see a little bit of widening of that gap. So we haven't seen that since 2020. The sort of slowing supply. And of course, interest rates bear a lot of responsibility for that. We started increasing them back in March 2022, but they really sort of kicked in 23 and 2024. You know, the really, really high rates. That's when we saw the rate maximums, I guess. We're at the end of 23. And that's put a real crimp on new investment. You can sort of see that here. On the other hand, it is a welcome development for a lot of operators because since that performance that we've seen in 2021, that really high, strong performance, we've seen occupancies decline generally. Now, that's the U.S. as a whole, and that includes all different types of locations, big cities, small cities, rural areas where we still see a lot of growth is in those rural areas and small cities. If we look at Atlanta, this reflects one of the two big themes that I saw as far as performance disruption goes. And one of those was natural disasters. And, you know, we saw a fair share of those that had some very severe effects on particular markets. But the other thing was regulation, and that predominantly affects larger urban markets like Atlanta, for example. And I know here in Atlanta, we've had the worst of all worlds. You know, it's not a strict regulation regime. It's an uncertain regulation regime. So people don't know exactly what the rules are or what they're going to be. Right. You can see that definitely has that's what investment does not like. That's what it likes the least, I should say, is that uncertainty. You know, we've seen more growth in listings in heavily regulated markets, you know, say Boston, San Francisco over the last couple of years compared to Atlanta, where we've been pretty much stagnant at the same level of available listings for at least the last 2 years, maybe even a little bit longer than that. So whereas, you know, the gap had just recently widened for the entire U.S., it's been continuously widening as time goes on in Atlanta because, you know, we're sort of at the same place. Some new people are coming in. I should point it out. Some new people are coming in, and they're replacing some bad operators that might be leaving. But you know, the net change is very, very slight. So we've seen that, you know, regulation can have a really, really big impact on supply growth. New York, I guess, is the most famous example. This whole last year, you know, New York's supply has dipped a whole lot, but the uncertainty in Atlanta, I think, is holding back supply growth, which is, you know, not great if you're an investor. However, there are some pluses. Here you can see the entire United States. This is the same graph as we saw earlier, but this is the year-over-year change in supply for each one of these months. And again, you can see that supply growth really peaked here in 2022. And that's, you know, also when we started raising interest rates. And then since that peak in, say, July of 2022, general trend has been slower and slower supply growth. So, you know, those rates kept going up, mortgages kept getting more expensive, and now nationwide we're under 5% growth. We haven't seen that since the pandemic, and we didn't see that before the pandemic either. So this is kind of an interesting historical moment. On the other hand, if we were to go to Atlanta, you can see that, you know, we cut down the supply much more quickly. The supply growth, you know, it was similarly strong, up there at 30% at the beginning of 2022, year over year. But it reduced, you know, sort of drastically, and has been negative for this entire year. So December was kind of a bright spot. This is the first positive growth in listings, available listings, I should say, that we've seen for the last 9 months. You know, so 8 months straight of year-over-year declines, and in December we finally sort of got a little bit above, a little positive. So a little bit more. A few more listings, I should say, this December than we saw last December. You can see we also had a lot of weird calendar stuff going on. So if you're wondering, well, why is September looking so bad? Well, you know, that's why that might be.
When you say calendar stuff, what do you mean by that?
Oh yeah. There were so many calendar shifts this year. So first we had, you know, the early Easter. So, you know, March was great, but then April stunk. We also had Thanksgiving. You know, there's Labor Day, I should say. You know, it was very much at the end of the month, so we saw a bunch of slippage from September because some of that ended up in August. Some of that holiday time, and then in December we had just like we did in 2019, we had Christmas on Wednesday. We had New Year's Day on Wednesday as well. So some markets this kind of helped demand, and some markets this hurt. So if you're relying on, say, long weekends, then this was not a great holiday season for you, because right in the middle of the week, it's the most difficult time to make a long weekend when you got those holidays right on Wednesdays. On the other hand, if you can take the whole 2 weeks off, and some people did, then you might be shopping for maybe a different type of product or a different type of experience than the weekend. Maybe one that's farther away, maybe one that's more expensive. And Atlanta has affordability and drive to attraction as some of its main strengths, as you can imagine. So we didn't see demand for the holidays materialize, really well in Atlanta for December. So a lot of holiday shifts. We did see supply go up a little bit. To look at demand, more specifically, this is it for the U.S. This is the total U.S.
Okay.
And what I tell people when they look at this graph is that the blue lines are bigger on the right side. So that's good. Though we have seen a little bit, a diminishment in this demand growth. Here, again, you can see August and September. There's that calendar shift again. We're taking on some holidays, some vacation days away from September and adding them to August. But even if we were to smooth that out, you can see over the course of October, November, December, the growth is kind of diminishing just a bit, which is not necessarily the worst thing in the world. What we did see is that 23 was so bad that a lot of people put off vacations that whole year.
Mm-hmm.
So we actually saw demand growth pretty strong in 24, I think, because of some of that pent-up demand. And we saw that after COVID as well, right? That was a huge effect. It was not driven by fear of inflation necessarily this time around, but I'm sorry, in fear of infection, but fear of inflation is what drove it this time around.
Right.
And now if we go to Atlanta, the things are a little bit different. One, we can see 23 was extremely difficult. Now, demand is in blue, booking is in green. So demand is people actually stayed during that month. Booking is that they made a reservation that month, but it could have been for a future date. So what we say is, the green is going to be somewhat predictive of future performance. The blue is the current performance. And as you can see, November and December, the demand was not very strong. And September was big and negative, but again, we had that calendar shift. And so September is not a huge month for travel anyway. A small change like that can have a pretty big percentage difference. We had been doing really, really well. I think the last time we met, in fact, we had data through August. And I'm like, wow, this is incredible. Look at this comeback. We've had all this demand growth.
Right.
But yeah, unfortunately, November and December were not quite as hot for the U.S. as a whole. They weren't quite as hot for Atlanta in specific. One of the things, though, that I am happy about is that we did see bookings remain strong. So,
well, this chart actually also demonstrates how extreme the slow demand was in 2023, like you pointed out, and a lot of us that were feeling that pain across the board. Clearly, you can see the big difference based on the demonstration of this graph for sure.
Yeah, a lot of people got into this market in 23, and I'm sorry. That's been tough because a lot of diminished demand. People were scared in 23. We've gotten over that a lot, but higher interest rates, as you pull those up, those also have sort of knockdown effects. They can slow the economy down. They can definitely make it more difficult to finance large purchases. So that has its own effect. But I think inflation was the biggest deal in 2023. Probably the determinant of the election as well, although I'm not a political scientist, but memories of 23 and the difficult times that people had, I think, stimulated a lot of discussion and talks about where the economy was headed. Luckily, things have been better, and you can see some of those calendar shifts too. That April, we lost that spring break Easter sort of holiday, and it plummeted. But other than those two calendar shifts, the year had been doing pretty good. But yeah, November and December, not quite as great as we would have liked. However, that's on the demand side. However, if we look at the occupancy, this is occupancy for the entire U.S. We're still a little bit below 2019, but the entire U.S. has done, 0.3% better on occupancy in 24 than they did in 23. So 23 is officially the bottom, as far as 0.3 year on year with all of our historical data. And we're hoping that that's going to continue because we're still somewhat where we're in 2019. So, there's reason to believe that we can still get back to there a little bit closer to that sort of 55%, 56% yearly annual occupancy that we had pre-pandemic. And it is doing better than this, though. And the spaghetti here. Now, is one of the things that you can notice is that Atlanta is definitely less seasonal. There's more compactness in the
Right.
occupancy.
Yeah.
Seasonality works a little differently, whereas a lot of places are really popular in August. Nobody wants to visit Hotlanta when it's sweltering in August. But the occupancy in Atlanta was up 3.9%. So even though demand was down a little bit because of that, we've had supply being diminished this entire last year. Is that if you survived in the market, there was maybe slightly less demand in December, but there was a lot fewer options for travelers coming in, and they were actually more likely to book with you. Generally speaking, December was actually kind of a wash with 2023, but the entire year, if we look at it on a holistic basis, our occupancy is up almost 4% year on year with 2023. So that's good. That also, what that says to me too, is that we certainly hit 2023. We hit the bottom harder, but I think we're starting to recover a little bit faster than the rest of the nation.
Yeah.
So, whereas it's only up by a minuscule amount, it's almost exactly the same occupancy in 2024 for the nation as a whole. We've definitely made some headway in Atlanta. We've still got a ways to go before we get that pre-pandemic level, but we're going to try to get there. And let's do it from the demand side this time. We would hope as well.
Right.
And that has had positive effects on RevPAR. And we'll look at these annual totals in just a little bit too. But RevPAR has been pretty good this year for Atlanta. This is Atlanta's RevPAR in green, and then ADR change is in blue. And RevPAR, generally speaking, has been quite a bit higher. The growth there has been higher than ADR, and that's because of that occupancy gain. So you can really see the effect here with some of these really large RevPAR increases on a year-over-year basis. Now, some of that, and I should, oh no, my skip. So RevPAR was pretty low back in 2023, and it's come back from a lower base. So that's one thing, but it's also come back pretty strongly in 2024 in comparison with the rest of the country, and a lot of that has to do with the occupancy. Have you seen anything like that? Have you been? What is your scope on pricing power, Rich?
Yeah, definitely, and we haven't really touched on this, but I think because of the extreme deduction that we did in pricing as well as occupancy in 2023, it definitely had a larger impact on the smaller properties because your margins are thinner, right? So all through 2023, I think a lot of the listings that came out of the market are typically more so the one bedrooms and maybe some of the two bedrooms that took a bigger hit, because anytime you have a percentage change in your nightly rate, when you go from $110 a night down to 80, that's an extreme hit versus, $300 a night to 270, for example. So right. We've definitely seen, and I've done this same analysis in a lot of the other cities, mostly in Florida, Tampa, Orlando, Jacksonville, also Charlotte, North Carolina. And they all seem to have this consistent theme of 2024 picking back up, and year over year, being slightly higher with ADRs and RevPAR and occupancies. So I think across the board, from what I can tell from the data that you guys are providing, you're basically looking as though we're kind of getting back, not necessarily to, pre-2019 levels, but we're definitely improving where we were in 2023 year over year.
And that's a really great point that you bring up about the smaller margin operations too. I remember having that discussion too when Georgia implemented that $5 occupancy tax, that sort of flat amount. And that was a few years back now, but there was a lot of places, if you've got a $35 nightly rate, then $5 is pretty steep.
Right.
And the clientele that goes to $35 a night places doesn't necessarily have $5 to pitch in. So that's exactly a good point.
Yeah.
I wish we had more data on operations.
Yeah.
Oh, I'm sorry.
No, and I think naturally, and this holds true across most cities, your one bedroom and smaller listings are usually 50% plus of the total number of listings. So you end up getting a bigger hit to each market because you've got the starting point is the majority of the properties are on the smaller side to begin with the smaller ADRs, right? So
and that's particularly true for urban areas like Atlanta. So
right, exactly.
We're talking about the North Georgia mountains. Those are all maybe cabins, but you're right. If it's a city, there's a lot of studios, one bedroom apartments, one bedroom homes.
Yes.
Well,
so I mean, it would probably be interesting to see, but I'm sure a lot of the degradation in the available listings over the last several years, it's probably been the biggest hit, I think, is in the smaller properties.
Hot dog. You know what, Rich? If you can remind me about that next time we meet, I will pull some data about one bedroom places. I can do that, and we'll see. Is that the case? Where is the attrition?
Yeah.
The next couple slides I've got, we did a whole presentation about the Trump policies because that's been a big change too. What are those policies going to be? What the effects they might have nationally, and then translate that to Atlanta in specific. But here you can see this is GDP that I've got. Just so this is the whole nation. Of course, every market's individual product is going to be related to this national figure because we all share financial markets and to some extent the labor pool and et cetera. And you can see here when that peak inflation hit back in 2022, the end of 2022, this was troublesome because this was also causing a big dive in our real GDP. So this is why people were so worried, and we were talking about recession so much in 2023 because when you've got this growth that's this low, that's what economists are gonna. You draw the line, it goes down, keeps going down, but amazingly, the interest rate hikes that we had seem to have done the trick, and it's never worked out this way before. You look back in the 1970s, 1980s, it was never this simple. So, as an adherent to the dismal science, I'm still going to be on the lookout for any weakness in GDP. But so far, it looks like we're doing really well. You can see a big bounce back in 2024. That is going to mitigate somewhat, and that's one of the reasons why I think the demand is going to slow a little as well in 2025. Not to say occupancy will, but demand might in the nation as a whole. So we've had some upward revisions to that. Now, what the Trump policy is that we wanted to illustrate is that over here in the end of 2026, that's when we're going to start seeing a little bit of a fiscal stimulus. Because if Trump cuts those taxes and also expends money and has some spending bills to enhance defense and border security, et cetera, this is going to have a stimulatory effect on the economy. Right. So we're going to see a little bit higher GDP at the end of 26. But watch out. There are some other effects, too. So one of the other things that Trump has said is that, part of that, border security is that the idea is in current GOP circles that immigration is somehow too high at its current level, and we want to cut it down. That's kind of the line, and that's what we saw in the first Trump presidency. predictions are a little bit easier for this because we do have a Trump presidency before, and we can look to that. And immigration was cut, and it was cut very severely in 2020, but it has crept back up to more sort of normal levels in the meantime.
Mm-hmm.
Maybe even new highs. So we would also expect that, were Trump to have all of his policies in place, that we would see sort of a similar decline, maybe about 200,000 fewer people per quarter immigrating on a net basis. Now, when this combines, there is some difficulty here because, all right, we've got an economy right now that the employment is pretty good, right? Our unemployment rate's hovering around 4.5%, somewhere in that range, which is historically low. So we're operating at near natural levels of unemployment, pretty much full capacity. And we talked about this too in 2018 when Trump wanted expansionary monetary policy, even though we were doing okay. But if you start stimulating an economy that is already performing pretty well, you start getting into the risk of having more inflation, and we don't like that. In particular, one of the reasons that we'll have inflation is their wage growth is going to be quite a bit higher, right? So we've got all of this stimulus happening. We've got a bunch of stuff we need done, and we're going to have fewer people to do it because the immigration is being cut. We know that labor has already been tight. Labor has been tight for a long time. This is a big concern in the hospitality industry in particular. And that doesn't look like with these policies that's going to be going away. So if you're looking at your expenses, you might think about maybe shoring up your reserves for additional wage growth that's going to happen probably, again, close to the middle end of 2026. Now, I said that this could stimulate inflation, and don't get too scared, though, because that's not to say that the pressure on inflation is going to lead to inflation, because we do have this backstop in interest rates. However, because the Fed, they're very, very conscious of wage growth and inflation, and they don't want to have a stagflation kind of rebound like we did see in the 1970s and 80s. They're probably going to, not be really eager about cutting rates, and that's going to be, one of the takeaways from all of this is that rates are to stay higher for longer. Now, Trump doesn't want the rates to be high. He's a hotel guy at heart, and hotel guys love building hotels, which means that he wants low rates. But right now, the Federal Reserve is, an independent agency. Jerome Powell, I recall he was in Atlanta when he said this. He was asked point blank at the if asked you to resign, would you? And he point blank said no. That still exists. So, whether Trump wants the interest rates to go down, it might be immaterial. I'm pretty sure that Jerome Powell is going to try to keep them a little bit higher, a little bit longer. So that is going to continue putting downward pressure on supply. So that's kind of our sort of takeaway, is that a little bit of demand stimulus by the end of 26, but also this sort of continuing difficult investment environment as well. And how this translates to the U.S. forecast. And here's the forecast that we developed. This is an econometric forecast. So we look at all that sort of interest rates, mortgage payments for a typical short-term rental. We look at, inflation and all of those things, integrate that in with sort of historical performance. And this is what we came up with. This still says forecast. I haven't updated this one yet. It's just missing the December data, though. So this stuff is pretty spot on.
Okay.
Demand is going to be increasing 7% in 2024. And there's some of that pent-up demand, 1.8 in 2023. So, not great in 2023. But some of that pent-up demand is really pushing this up to 7. We're expecting that to slow down with lower GDP growth and, a little bit of satiation as far as some of these travelers are concerned, 4.9%. But because of that high interest rate and the supply being very difficult to bring into the market, it's going to continue to decline, and it's actually going to come in under the demand. So 4.7, and that's going to actually help our occupancy start getting back to that 56% long run average. And it should actually reach there by the end of 2026. Some of that fiscal stimulus is certainly going to help. We're also going to see, pretty modest ADR change. We might revise this upward a little bit because, ADR growth was pretty good in the U.S. and in Atlanta as well for November and December. But in any case, it's a far cry from the RevPAR that we saw in 2023. That RevPAR growth of negative 8.5%. That's very difficult to make your investment paper with that kind of RevPAR growth. Now, I want to contrast this too with Atlanta, because Atlanta is if we look at this nights listed change, you see it cuts off so much faster. So it goes from 14.2 in 2022 to negative 2.6 in 2023. And just to give you just to scroll back up again, just to compare it with the U.S. Doesn't go negative. It's still not negative. And 8.3 is very strong. So we saw this big downturn in demand, 7.5%. However, that supply contraction helped our unit level performance. So we lost some occupancy, but we didn't lose a huge amount of occupancy because supply wasn't. If supply had been growing in Atlanta the same way it had been growing in the rest of the nation, we would have seen occupancies plummet. But as it was, only declined a little bit. ADRs remained positive. And if I'll go back up again, just to give us a reminder about what the U.S. was doing with their ADRs, in 2023, nationally, ADRs declined. And whereas in Atlanta, they kept going up. And I think a lot of that has to do with what you were saying, these sort of low-quality properties with lower ADRs, they're kind of dropping out, and the average goes up as a result.
Right.
And that helps buffer it. But at the same time, we also again, this occupancy is helping out the remaining short-term rentals. It's not like it's lower, but it's not apocalyptic, the occupancy. So we could still have some modest increases. RevPAR, as a result, it didn't decline 8%, but only about 2% generally. So very tough times. But to some extent, that low supply growth has kind of insulated Atlanta from maybe the worst effects of the last couple of years, because we don't have that sort of runaway supply like we've seen in much of the nation. I'm expecting, and this is a big disclaimer too, I'm expecting this big demand shift. We're going from about flat in 2024 to 6.4% growth. That's going to get us back to the demand that we've already seen, right? Because we saw a 7.5 decline in 2023. So I think it's doable. However, as I was pointing out to you, this is also assuming that nights listed, the supply actually increases by 2.1%. If we see further declines, then we might not be able to accommodate this extra demand. So it might not be that high if the supply number is lower.
That makes sense.
On the other hand, that may help. Our occupancy is going to be going back up to that sort of 55, 56 level, closer to where it was in 2019. It's going to be going back. We did in Atlanta, we hit a lower low, but we did bounce back a little bit more quickly in 2024. And, we're going to continue increasing that occupancy. So if we were to see that nights listed, this will come in at lower than 2%, we might even see occupancy going up just a little bit more as a result of that. We're going to continue seeing good improvements to ADR. We've still seen ADR increase. In December, we saw ADR increase, even though the occupancy was down, or it wasn't the occupancy was down, the demand was down. But we still saw ADR increase, and we're expecting that that's going to continue, not at a crazy pace, but similar to what we saw in 2024, and that's going to help our RevPAR. So pluses and minuses of the supply. On the one hand, it is difficult to accommodate demand. It is difficult to move into this or expand your operations in Atlanta, especially with interest rates. But on the other hand, if you are operating in Atlanta, that is giving you a little bit of protection from some of the some of the demand shifts that we've seen over the last couple of years. And that's what I've prepared right now. But and feel free to I'll distribute this, of course, Rich, so all of your audience, of course, can have the copy of this. And I'm really interested in looking at like that breakdown, like you described, as far as the bedroom count goes.
Yeah, I mean, just my own personal portfolio, we went from probably a good 40-50% of our portfolio during COVID was one bedrooms. Um, Probably beginning part of 2023, latter part of 2022. I had a lot of buildings that we had under master leases, and so I just didn't renew them because of the margins getting tighter. And
Sure.
obviously, being involved with the community, a lot of other folks experience the same dynamic. And so I know firsthand that a lot of the listings that we got rid of or didn't renew were one bedrooms. Now, during that entire time, 3, 4, 5 bedrooms, I think the diminish in demand and occupancy had a lesser impact. And if anything, I think we actually saw a little bit of a surge in activity with more folks coming into Atlanta for contracting works on large projects and staying longer, 3, 4, 5 weeks at a time. And a lot of these contractors, instead of staying in economy style hotels, recognize the benefit like everybody else. Have 5 different contractors stay in a 5-bedroom for much less money.
You got a kitchen,
and got a kitchen, a lot more comfortable, and so we had a lot of that type of activity, and we still do right now on the larger properties. And so, again, like I mentioned before, I've seen the exact same, impact on smaller properties in a lot of the other cities in the Southeast. I think for the same reasons, the margins just get too tight.
Yeah, it's interesting. We've seen there have been a lot of natural disasters, and the big first effect, of course, is that supply gets pummeled. But there is a lot of construction work that happens afterwards. It really taps into that sort of medium-term stay market. So I'm expecting. I think Airbnb has already come out and said we're going to try to have as many listings as we can for emergency and construction workers in LA, for example, as that they can. And similar things happened up in Asheville. I've got some friends up there, and the hurricane damage was pretty severe, and so there's going to be months and months of rebuilding.
Yeah, and well, plus the whole west coast of Florida, the same thing is going on down there. There's a lot of construction and rebuilding as a result of the hurricanes that came through there, and people being displaced and needing somewhere to stay, as well as a lot of the workers that are coming in. The same dynamic.
So medium-term stays, lots of bedrooms, maybe a little bit more upscale offerings. I think all of these are good prospects for 2025.
Yeah, definitely. And I think now that we, at least based on historical data, feel like we're starting to see an uptick or expect an uptick in ADR and RevPAR. Perhaps some of the one bedrooms can start coming back where it makes more sense now to those levels, hopefully, going into 2025.
Right. And if we can get some of this, again, some of these regulatory issues sort of straightened out, at least, set out very clearly and have a set of rules that we can all agree to. And I think we can also see maybe some more development from the investment side.
Have you seen any recent regulatory impacts, similar to New York, where you've got a surge of listings in New Jersey as a result of the restrictions in New York? Have there been any other pockets like that you've seen?
Actually, Burma had me studying Buncombe County because there was a bunch of proposed regulations, try to limit short-term rentals around Asheville. But again, now with the hurricane damage, I think a lot of that stuff has been tabled because they need those places for people to stay in for a time. So, we look internationally as well. So I think of course Barcelona is trying to outlaw these things. A lot of folks moving on down the coast in Spain. But I think a lot of cities now are actually looking to the New York example and noticing that it really hasn't helped housing affordability in New York. Right. I don't think anyone, I don't think anyone that seriously looked at it thought that it was going to help. But now we've got evidence to back it up. it's still expensive to live in New York, even though you can't run a short-term rental there.
Yeah, and I guess we saw the same thing happen in Orlando several years ago, where we've got a surge of listings still to this day in Kissimmee as a result of Orlando's heavily regulated. You can only host guest if you're physically in the property legally in Orlando. So,
right, yeah, I don't know if the constitutionality of that has been well established, but travel being such a repeat business, it does a disservice to your whole local economy, I think, to shove a lot of travelers out, even for a short amount of time.
Definitely. Well, in closing, I think the message here for 2025 seems like we're kind of optimistic about things getting better. Obviously, much better than hopefully what we experienced in 2023. Do you have anything else to add?
I'm hoping for even keeled. It's been a roller coaster ride this last few years. So I'm hoping now we're going to finally get some, years that we can use as benchmarks later and say, oh yeah, 2025, that was just a perfectly normal, so we'll do all of our comparisons against it. Since we moved so far away from 2019, that was what we had used for a long time. So I'm hoping 25 is the new benchmark.
Awesome. I hope you're right about that. And so thanks as always, Bram, for spending a little bit of time with us today. And I'd love to have you back in April, do the same thing for the first quarter and kind of have a look back and see how we did. And would love to have you back again for that.
Absolutely. And do remind me to follow up on that bedroom analysis, because now I'm curious.
Yeah, most definitely. Yeah, we'll definitely remind you on that. And, it'd be interesting to see how that's when you peel back the layer of the onion to see how that's impacted compared to the average as a good indicator. All right. Well, thanks everybody for checking us out. As a reminder, B&B Investing Group does work with new investors that want to learn a scalable business and grow with short-term rentals. If that's something that you're interested in, feel free to reach out to me directly. There should be a link below for my calendar, and we can schedule a quick call. And if not, I can point you in the right direction if you're not a good fit for the B&B investing program. But Bram, thanks again, buddy. Really appreciate it. We'll look forward to seeing you again on the next go round. Thanks again.
Always a good time. Thank you.
All right. Take care. Take care, everybody.